How do you do, ladies and gentlemen? I'm your host, Seth Julian, welcoming you to tonight's session. The UK economics and the situation is serious. We're going to look at market trading opportunities, try to learn how to make a few dollars out of this terrible crisis, because it is a crisis. Let me please ask you to indicate on the question area whether you can just hear my voice, see the opening screen, and we'll begin forthwith. Just some simple acknowledgement to let me know that I'm not broadcasting into the ether here. Let me know that anybody can just hear it, see it, and we'll begin straight away. Let me just introduce myself in the meantime and tell you that my name, of course, is Seth Julian. Yes, I can hear you well. Thank you, Sis Stephanie. Beautiful. Everything is clear, Sis Elias. Great, great. Wonderful. Hi, Sibu, good to see you as well. Great, that's enough, folks. That's just plenty. That's great. Let me introduce you by telling you that I am, as I say, Seth Julian. I am the Chief Global Strategist here at Alvexo. I've had 3 positions at major international trading houses. My first at Bankers Trust Company on Wall Street in the early 1980s. And I have a training and degrees in political economics, international trade and economics, and management and finance. I'm 65 years old. I've been trading for 52 years now, and I made most of my experiences gained trading commodities. So I've been trading stocks, stock options, CFDs, FX, bonds, indices, the works. So pretty experienced. And my job today is going to tell you how to look at the situation in the UK, try to understand it macroeconomically, and show and explain how we can perhaps trade a few dollars and make some money out of it. With that, let us just get right underway. Dry weather, inflation, industrial disputes, transport snafus, and political paralysis. As Michael Gove, a cabinet minister, admitted recently, parts of the United Kingdom are hardly functioning. It's Britain's summer of discontent, as opposed to the winter of discontent, which I believe was Steinbeck's last novel. Anyway, I won't go into that, but it's a famous phrase, and it is Britain's summer of discontent. Prices rose 9.4% in the year to June, driven in part by wholesale energy markets. Now, for those of you who are not aware or not Britons or living under a rock, Europe is suffering a tremendous energy crisis, perhaps I might even say worse than the 1973-4 oil crisis or the 1980 oil crisis, because they are much more reliant on imported natural gas than they are crude oil because of their reserves, what are left of them anyway in the North Sea. So because of the NATO-Russo war, which we're going to talk about next week, I believe. Yes, the NATO-Russo war, which has tremendous trading implications, and that's going to be next week at the same time. Because of that war, energy prices have effectively quintupled. That means gone up by 5 times. And so certainly Germany, and no less so really, we don't hear about it as much, but no less so the UK, which are fully reliant on cheap gas from Russia, are in deep trouble. Now, the government has helped mostly by handing out cash to households with further benefits for the poorest, unlike in Germany, which slash fuel taxes. And for those of you who are following this, and I suggest you do because it's very important for us as traders, the EU is trying to, and I might say making a reasonable attempt at, coming up with a unified policy to deal with this problem. And it ain't easy. In my opinion, whatever policy they come up with will still lead to fighting amongst the members, rationing, hoarding, and not sharing. That's going to cause terrific political economic problems. But nonetheless, Britain's approach is better targeted and does not encourage energy use because of the way the Germans are managing. It's actually driven up demand because they've made it essentially cheaper than the actual market price is, and thereby well, let's just leave it at that. Energy price inflation in Britain stands at 57%, compared with 42% in the euro area, according to the OECD. Oh yes, I forgot to mention, ladies and gentlemen, should you have any questions, please feel free to ask them as we unfold here, because it just makes the entire undertaking more interesting for everybody. Many goods have become more expensive. The price of milk, which is a favorite question for interviewers to see if a politician is aware of the prices of ordinary goods, rose by 21% in the year to June. That means from January to June. Doesn't mean a year, in fact, it means from January to June. As some products rise in price, others shrink in size. The Grocer, which is a trade publication similar to the one in the United States called Progressive Grocer, finds that own brand ready meals at Tesco, which is a major retailer in Britain, Britain's largest supermarket, have shrunk from 800 grams to 750 grams and from 450 to 400 grams. I guess they have two sizes. Industrial unrest is spreading as workers try to keep ahead of rising prices or try not to fall too far behind. In 2019, the last year of records, 234,000 working days were lost to labor disputes. Railway workers alone drove this year's figure higher. More than 40,000 workers walked out on June 21st, the start of a series of ongoing stoppages. Postal workers are going to knock it off soon, too. The Royal College of Nursing is surveying its 465,000 members about a strike, which will be the first in its history, by the way. Ian Woodley, the regional organizer for the night union, is surprised by how fast young workers have been unionized. Quote, they've never been in a union before, let alone on a strike. He suspects that workers have been emboldened not just by galloping living costs, but also by Britain's tight labor market. That's an important point. So we've got this situation where prices are rising, unemployment is very low, and workers are feeling very empowered to initiate labor stoppages. Now, whereas some are angry about pay, many are quietly grumpy about the state of public services. Over the past 5 years, the proportion of Londoners who think that the police can be relied upon has fallen from 80% to 57%. 2 years ago, during the worst of the COVID-19 pandemic, Britons felt warmly towards their local councils. That did not last. In June, this past June, only 52% said their council acted on residents' concerns, the joint lowest figure for a decade, in a survey conducted 3 times a year, I might add. On a recently seen street, the weeds that grow in the edge of the pavement were almost 2 meters high. Things are not functioning well. Oh, and by the way, let me just make a slight aside and say, mention the passing of Her Majesty the Queen, and long live Charles III. And yes, Barbara asks the question what the effect of that might be in this soliloquy of woe. The truth is nothing at the moment. It's possible that the new king might make the position what they call a bully pulpit, to use Churchill's turn of a phrase, meaning to use his position to rally support for British economics and British socioeconomics in general. I doubt it. I think the situation is so bad, there is no real opportunity for that. So my feeling is the feeling of many, the passing of the monarchy from Elizabeth to Charles is irrelevant for our discussions. But thank you for asking, Barbara. If the National Health Service is the closest thing England has to a religion, as Nigel Lawson, a politician, is reported to have said, the country is falling into unbelief. Only 36% of people are satisfied with the NHS. And I mention this because the NHS is probably Britain's most well-respected institution. This is the lowest figure since 1997. Fully 6.6 million people are on a waiting list for treatment, up from 4.4 on the eve of the pandemic. Ambulances are supposed to respond to, quote, category 2, which are serious incidents, such as suspected heart attacks and strokes, within 20 minutes. The average in June was 52 minutes. 1 in 10 waited for at least an hour and 54 minutes. That's a serious event, 2 hours. Now, Britons might wish to escape such problems by going abroad, but airports have canceled flights for lack of staff. I don't know if you've been following that malaise at Heathrow. People waiting in line only to see on the departure board their flights disappearing. Dover, the main seaport for continental Europe, has seen long queues for passport checks. Even getting a document can take many weeks as the passport office buckles under high demand. 28,000 members of, quote, Passport Appointment Help, a Facebook group, swap sob stories and advice for speeding up the process, such as hassling members of parliament or turning up at passport offices without making an appointment. Now, most people expect Britain's economic ills to persist. Take a look at this chart. This is a chart that appeared in The Economist magazine that shows economic optimism index. It's a sentiment survey that is undertaken, I believe, every 6 months. But and we see them in the United States. There's a famous one in Germany, ZEW as well. They have their role. I wouldn't trade on them, but they are important indicators, certainly in our particular case because of the dire situation in Great Britain. And we see here that it is the share of people who think the economy will improve in the next 12 months minus the share of people who think it'll get worse. So there's a net 60% of the population think it's going to get worse. That's pretty bad. And particularly when you look at, this is COVID and this is post-COVID. So it's felt to be bad, and it is bad. We're going to take a look at some actual charts in a moment. Now, most people expect Britain's ills to persist. In its monetary policy report on August 4th, the Bank of England warned of an extended recession and said it would expect inflation to reach 13% later this year. Cornwall Insight, which is an energy consultancy, projects that the energy price cap, which is the policy that the Brits have installed, which means to limit the price of gas, which there are many critics, but it is an approach. It's not a true cap, but an indication of the annual bills paid by the average household to more than double from 1971 pounds to 2380 pounds. At present, to 4,427 next April. That's their projection. So what's that? Call it 2,000 to 4,500. Huge increase. The NHS will probably come under great pressure in the winter. So that at least paints the picture of what's going on there. And we drew from theeconomist.com, our usual sources, Bloomberg News, Bloomberg TV, the New York Times, Wall Street Journal. And this book, which, by the way, I highly recommend to you folks, if you have a chance to read it. It's called The World by Richard Haas, published in 2020. It's a fabulous, quick read, and it will bring you up to speed pretty much on the entire world socioeconomic situation. Fantastic book. I highly recommend it. And it's just a great read and intro as to what's going on. So first, let's open up the floor to any questions, and then let's take a look at some actual phenomena to see if there's any money to be made out of this. And believe me, there is. Questions, ladies and gentlemen. Okay. Oh, sorry. Here we go. Take a look at this. We entered this position today. It actually had a slight reversal, but we only entered it today because we left it after a fairly long position here. We did very nicely out of this. This is pound Swiss. This, by the way, is the MT4 platform, which all of our clients receive free of charge. And I break out the different assets that we have. This is a list of all the assets that we carry in the house, and I break them out into different categories for ease of reference. And this is one of 3 foreign exchange categories. And so here, pound Swiss. The Swiss has gained tremendously. This is the position we're in now. You can see it. It's a short, needless to say. It's just gained tremendously against the pound. And for those of you who are unfamiliar with how these graphs work, and this is one of the reasons I'm constantly railing against the ignorant commentariat that says the pound is up, the pound is down. It's a nonsense statement. You can only say it's weaker or stronger because, for example, in this case, you would say the Swiss is down, the Swissy is down. That makes no sense. It costs less Swiss to buy 1 pound. Any currency pair or any asset pair for that matter, if it's oil, it's not just plain oil, it's oil versus dollars. Gold is 1 troy ounce per dollar. And so the exponent on the left-hand component of any pair, be it oil or cotton or field crops or foreign currency, is 1. And the exponent of the right-hand element is what's printed on the Y or vertical axis. So as it gets stronger, it requires less to buy one of the, what Squitter refers to as the base currencies. In this case, the base currency is the pound. So it's getting, as the pound weakens, it takes less, as Swissy in this case, to buy the 1 pound. And lest you think that this is not that serious, I want you to take a look at the volume. This is the volume on this decline is tremendous. It looks to me to be well over 3 times the average volume. And so that means that there's a tremendous amount of sentiment behind this. It's below the 20-day, the 50-day, this is a daily chart, and the 200-day moving average is barely visible in the rearview mirror. This indicates very strong sentiment behind that move, and therefore, pardon me, a very high likelihood that this is going to continue in its decline. Questions, ladies and gentlemen? Yes, there is one from Elias. If a recession starts in Europe, how long will it last? First of all, my friend, there is a recession in Europe. Any of these commentators that say that there might be a recession, there could be a recession, we're near a recession, we don't know, it's full of shit. We are in a very serious recession, okay? Leave us make no mistake about that. We're in a recession. It's here. It's been going on since January. Whatever the official technical textbook definitions of a recession are, 20% reduction in GDP growth, whatever it is, we're in it. Okay, anybody who owns anything has seen the value of what they own in terms of stocks decline radically. So yeah, we're in a recession. How long will it last? I'm not that good, Elias. I can only tell you where things are and what the direction of movement is. I can't tell you how long it's going to persist. My personal feeling is that it's certainly going to last in the case of the UK as long as the war persists. And the war isn't going to be over in a few months. Contrary, again, to a lot of the nonsense you hear about, this war is here for a long time. The Russians are playing it for the long term, and we're going to talk about that in much more detail next week. But yeah, at least for the duration of the war. Let's say. Well, I don't know. The answer is I don't know, and I really can't make a prediction. It's going to be here for a while, though. It's not going to be over in a quarter or a half a year. Or here's some of the nonsense you hear. By the end of the year, the central banks will have wrung out price inflation by virtue of raising the cost of money, aka the interest rate, and therefore will be stabilized. Oh, here's another nonsense term you hear. We'll have a soft landing. Give me a break. There's no soft landing here. Things are crashing. My place is not to go into the perniciousness of inflation, which is a very pernicious social ailment. But suffice it to say, it's very hard to wring it out once it takes hold, and it's taken hold. Okay, so that's the pound Swissy. Here's the pound CAD. Also very similar, enormous volume. Not kissing the 20-day, that's a daily average, 20-day moving average, but still the 200-day moving average is in the distant rearview mirror here. Another terrific trading opportunity because, well, in the case of the pound CAD, the Canadian dollar, the loonie, is highly reliant on the oil market. And since the oil market has just taken a little return in the last week, the prices have eased, the Canadian has weakened the tad, but you get the idea. These are great trades that are not very hard to conceive and to understand. You just need to enter them. Let's take a look at the pound dollar, which of course, cable, which is the really the granddaddy of them all. Same pattern. You get the idea. This is not hard to trade. These are tremendous opportunities. We've done very well out of these trades. Many people who are following our signals and follow the daily briefings are well aware of this position. And traders around the world are well aware of it. We're doing very well out of this. I'm sorry to be so explicit in my simplicity, but it's a simple proposition. The UK economy is on the ropes. They're having a real tough time. Remember this, we've got a number of factors beside the energy crunch and the NATO-Russo war, we've got Brexit here on our plate. And that was probably, at least in the near to long term, one of the dumbest things that a country could have done to itself, beside actually entering into a war of choice unnecessarily. But Brexit plays its role here. Make no mistake about it. In fact, this constant talk, and there has been certainly since 2016 when they decided to leave the Union, of a breakup of the United Kingdom itself. Scotland has voted several times unsuccessfully, but is still toying with the idea of saying goodbye to the Union. That will further be a kick in the pants to the UK economy. So I hope you're getting the idea here. Recession, war, where is oil price going? Osman says. That's a good question. It's a little bit off our theme tonight, Osman, but oil. Well, I'll show you. I'll actually give you a quick choice. I want to finish the. Well, I think that really says. Oh yes, I did want to finish one thing before I answer your oil question, Osman. I want to take a look at the FTSE, which surprisingly is doing very well. UK 100. Take a look at this. This is, am I on the daily chart? We'll make it a little small, get a little bit more data. This, of course, is the, well, let me give you a little more data. This, of course, is the fall off from the pandemic. And you can see it's been doing pretty well. However, not in the last, let's call it 6 months. It hasn't been doing so well. It's fallen off. It's pretty much at value, meaning you can see the prices at the 20 and the 50 and the 200-day moving average. In other words, it's not radically below or above the value that the market has placed on it. And let me just digress a moment by saying that these are moving averages, in this case, exponential moving averages, but that's fairly irrelevant whether they're simple or exponential or any other type for that matter. Averages of price tell us value. Price itself tells us next to nothing. All you know is that 72, was it 72.62, 72, I can't read it. 72, 82, yes. All we know is that a transaction occurred at that price. We don't know if the buyer got a bargain or was taken advantage of, or all we know is that a price a transaction took place at that price. Whereas value is price over time. So this number, and let me get you a slightly better chart. It's more visible here. If we take a look, and we'll go to the FTSE. Here's it's called the UK. I get the change all the time. Here we go, the UK one. On this, you can see, get rid of this. The 200-day moving average for the FTSE is 73.28. So we're slightly below the 200-day moving average. And you see the 20 and the 50. So this, by the way, of course, is TradingView, the finest charting service available on the internet. You can get a free version, which is nearly as good as this. I pay a small fee for this particular version and get a couple of extra benefits that you can really live well without. But this is TradingView, so you get this feature where you can you see the data on the chart. Also gives you a visualization on the price axis. So it's just dancing around those, but I want you to note this: volumes are declining, and the force index is in negative territory. So that, to me, those are important indicators of, what did I do? Those, I cut it out. Okay, let me see if I can reverse that. Maybe I can. Never know. All right, forget it. I don't want this. Never mind. I'll stop fooling with this. But those are indicators that this trend is, we are, in my estimation, looking at what is likely to be a reversal in the FTSE as well. So that concludes our tale of woe for the UK assets. However, and I'm going to be frank about this, I'll get to your question in one moment, Jean-Claude. If this seems particularly simple to you, it is simple. I don't want you to think that trading has to be this complicated voodoo technical lines and graphs challenge for people to see things in the weeds that aren't there. This is visible to a child. We can see this. This is how, and our job as traders is to simply take money out of the markets when possible. And believe me, it's quite possible here. So that's all I really want to say about this particular scenario, is that the UK is in deep shit. Very, very serious problems. And this makes our the opportunities available to us as traders quite evident. And therefore, it behooves us to take advantage of them. That's the whole story. Now, I want to get to Osman's question about oil. We'll take a look at WTI and then Brent, which are tracking pretty much an identical pattern here. So oil has been falling now since about the middle of June. And it's fallen off from 124 to 85. I'll tell you exactly how much that is. Turn on the little calculator. 124.85 is, it's 31%, 31.45% decline from here to there. It's a big, big drop in a asset as important as crude oil. And I want you to notice the volume is tremendous. That means that there's a lot of sentiment behind that, or what the physicists might call momentum. It means that this fall is not some fall that really doesn't have any legs behind it. Au contraire, it's got great legs behind it, and it's therefore likely to continue. Now, let me just say one thing with respect to likelihood and likeliness and risk. All right, these are the capital markets. There's risk here. And what is risk? Risk, after all, is nothing more than the probability of the unexpected occurring, and occur it does. And that means that if you are trading with money that you can't afford to lose, you're being foolish. You must be prepared to lose, because lose we all do. Don't think I never lose. Don't think anybody who makes money in this business doesn't lose. We all lose. It's just a part of actually any endeavor, whether it's sports or music or art or professions. I think every doctor doesn't make a mistake. Doctors make mistakes all the time, but they learn from them. And by learning from them, they turn their losses into modified gains. They try not to make that mistake again. They learn from them. Same with trading. Yeah, we lose, but we try to learn from those losses and not repeat the mistakes. But if you don't have the stomach to lose your capital, this is not the business for you. If, on the other hand, you do have an appetite for risk and you're able to absorb loss now and then, this is a terrific business, because, after all, one of the sine qua non of success in this business is merely to make more than you lose. And while that would seem to be a low bar to attain, it's actually surprisingly not. And for those of you who are trying to learn this business, you know damn well it's not easy to do. But it's a business like any other business. You have to put your time in, you have to pay your dues, you have to do your homework. But one of the great satisfactions to me and many other long-term traders is that it's the classic example of knowledge, of a business where knowledge is power. If you understand what's going on in the UK economy, and you look at those charts of a pound, the Swissy pound, pound Swiss, or dollar, a pound dollar, that you know what to do. And that's really a terrific feature of the business. So let's take a look at oil. You see that oil is going down on great volumes. That means a lot of traders are behind this, and a lot of traders think it's going to happen. I'll give you one more insight here. Again, I'll go back to TradingView because it offers us another another feature, another graph that I want to show you, called the Commitment of Traders Report. And that's here. Let me bring this into, this is an hourly chart. I'll give you a daily chart, a little more useful to us. If I can find it here, here's the, come on, here's the daily chart. Now we see on the Commitment of Traders Report that the net large speculators are long. So they're wrong on this, which is surprising. Often, that's not entirely surprising. The net long speculators the large speculators are expecting price to rise. They're wrong, obviously. Now, They may be right in the future, but they're wrong now. So I would not be buying oil to go long. I would be selling it short, Osman. That's my short answer to you, long answer to a short question. Seth, hi, could you explain the difference in the relation between pound Swiss and pound euro? Let's take a look. My guess is not much, but let's take a quick look. If we go back to, I think it's in FXB, pound Swiss and pound euro. That is what he asked, right? Pound Swiss and pound. So we saw pound Swiss just a moment ago. Where's pound? It's euro pound, by the way. It's not pound euro, it's euro pound. But you'll see it's tracking the same thing. It goes from, is this a daily? Yes, it's a daily chart. It goes from 0.835 to 0.971. So let's take a look at that. 0.835, 0.971. Excuse me, 0.971. It's a 10% reduction in value of the pound versus the euro. And that's in other words, costs 10% more euro pounds to buy that same euro here. It's not the same, obviously, as the Swissy, but it's a significant weakening. Now, the euro itself is weak as well, whereas the Swissy is very strong. So that's why you don't see that same long-term decline, Jean-Claude. So I hope I've answered your question. And if I haven't, please let me know and I'll do it again. FTSE DAX, FTSE are high in relation to your perspective of economy of these countries. Why, if the big companies still make a profit they used to make, why? Did reality did not arrive in business numbers already? Excellent question, Enrique. And the answer is a little complicated, so that's why I paused. But oh, good. I'm glad to hear that, Osman. Here's the rather complicated answer. I shouldn't say rather complicated. It's a simple truth. I don't generally like to complicate. I try not to complicate it. And generally, I find life is a lot simpler than particularly the commentariat in our industry like to make it. I'm a big enemy of jargon, and particularly in my own industry, which is filled with it. And jargon is simply a means to be condescending, to make the user of the jargon think he sounds more intelligent than he is. It's bullshit. It's obscuring, and it's talking down. When doctors speak Latin or Greek to you about a situation you have, they may pretend or think that they're sounding smart, but in my opinion, they're sounding ignorant. The idea is to explain it to someone who didn't go to medical school. Anyway, if we look at corporate profits, and we get a pretty good look at them once a quarter, and in fact, an obsessively frequent look, in my opinion, but nonetheless, that's what we get. We see two things. One, corporate profits are still relatively strong and holding up. So you're correct in that, in your observation, Enrique. Corporate profits are there. However, we also see another parallel phenomenon that we started to see in the Q2 reports, which again, Q2 reports that come out in the second quarter are really reports about Q1. And that is the what do they call it? The warnings, they call it, the projections. In other words, they say, okay, profits are holding up, but we expect sales to decline. And those profit warnings have been coming loud and clear now for half a year. And they're going to continue again in the second quarter, which began a couple of weeks ago. We're going to see it again with the profit warnings and top line revenue warnings weakening. So it takes time to filter through. And the revenues, the top line revenue figures are going to weaken because inflation is going to drive people to hunker down and stop buying. It also has a certain phenomena which we really must be aware of, that when inflation shows its ugly head, and the central banks apply the tools that they have at their disposal to stop it, to arrest it, which is essentially raising the cost of money, i.e. the interest rate. We see a phenomena whereby the people, in a common Wall Street aphorism, sometimes attributed to Mr. Buffett, though I'm not sure about it, he says that when the tide goes out, we see who's swimming without a bathing suit. And what that means in our case is when interest rates go up, in other words, we've been living in a period pretty much, I don't know, let's call it from 2007, what is that, the 15 years, of free money. Free money. You can borrow money and return it with no cost. You just return the same, like borrowing from your family, unless, of course, they charge you interest, which most families don't. You repay the loan with no interest. So you see people wearing $20,000 wristwatches and driving $150,000 cars, et cetera, et cetera, et cetera. But when the cost of returning the money they borrowed to look the way they do, or in the case of corporations, to buy the revenue flows that they've acquired through low prices or through advertising or however they've done it, they're going to have to pawn the watch. They're going to have to get rid of the car. They're going and the corporate parallel to that is their profits are going to fall. So these rosy performances that we've seen literally for years now are coming to an end. So that's really the answer to your question, Enrique. All right, then, ladies and gentlemen, any more questions? If there are none, I'll bring the session to a close. Let me just remind you of a couple of things that are important. One is you're going to see on your dashboard a poll. I want you, if I can ask you to fill out the poll. And at the end of the session, there's a quick little survey of a few questions. Please fill it out if you can. It helps us a great deal. And in fact, many of these topics are chosen by you. We just follow your leads on this, and it's very helpful to us. Also, the feedback on, however you think I've done or however you'd like me to improve are also welcome. Secondly, we have, obviously, for our clients who are aware of the kind of work we produce and the kind of advice that we give and provide, this is an example of how we work. We do the best we can for our clients. We're a stand-up, honest, straightforward brokerage. We really do our homework and do the best we can for our people. We're not right all the time. We don't pretend to be right all the time. But we do, after all, make more money in the long run than we lose. And that is, as I said before, the sine qua non of success in our business. And those of you who are attending tonight who are looking to open an online brokerage account, please consider opening one up with Alvexo. This is really an example of the kind of work we put out for our people, and you could certainly feel welcome to this type of product on a regular basis. So Jean-Claude asks another question: what makes CHF stronger than euro? The Swissy is a unique currency in many ways. The Swiss don't really produce much other than watches, Swiss knives, and chocolate, but they're the world's bankers. They manage a tremendous amount of wealth. There's a lot of money, cash, sitting in Switzerland, and it makes their currency very reliable and strong. It's a safe haven, is what I'm trying to say, Jean-Claude. Swiss currency is a traditional safe haven. And I don't want to underplay the fact that they're a neutral nation. And that neutrality has stains on it. Their neutrality during the Nazi regime was not lily white. But on the other hand, they were neutral. They tried to be neutral. They didn't succeed in every case, but they saved people and they were neutral. And that neutrality isolates them from, in particular, the misery and hell that's taking place in the Ukraine or Armenia or Azerbaijan and Nagorno-Karabakh. You name it, there's plenty of nasty horror on the European landmass once again. And the Swiss are thankfully free of such misery. So it's a strong currency because the economy is largely based on banking, and the fact that the country can stay above the fray, as it were, also does it well. I hope I've answered your question, sir. All right, ladies and gentlemen, if there are no more questions, and certainly I'd be happy to entertain any more that you may have, let me say that on behalf of the staff and the management here at Alvexo, that we are always humbled and grateful for your patronage of us as your online broker, and that we look forward to serving you again in further sessions. Tune in next week at the same time, where our subject is going to be the NATO-Russo war. And we're going to talk pretty frankly about that. I should say I don't, in that particular case, I don't speak for the management of the firm. I will tell you that it is my opinion that a lot of the commentary that we read about Putin and Russia are wrong. This is a war that was largely created by NATO and the Western Alliance. It could have been avoided. And there are reasons for it, and we'll go into them in depth. But let me assure you, for those of you who aren't aware, and I'd be very surprised if any of this crowd isn't aware of it, this war has created unbelievable trading opportunities. Really, liege, way more than, just, they're everywhere. We'll talk about them next week, I assure you. But so tune into that. And so, ladies and gentlemen, with that, let me say that I'm your host, Seth Julian, wishing you all, ladies and gentlemen, the ability to trade with confidence. Bye-bye for now.